Hey, welcome back, everybody, to the Today's Market Explained. This is the show where we catch up on the markets, on everything that's going on in the world, and give you guys an update. I'm Brian Castle. I'm your host. I'm here with Mr. Christopher Reardon. Chris, welcome to the podcast.
Yeah, thank you, Brian. Glad to be here and glad to talk a little bit about these volatile and turbulent markets for sure.
A lot of interesting things we never thought we'd see. But anyway, well, Chris is our director of development. He's a master of all things portfolio. He is a super smart guy and my longtime co-host. So, Chris, again, thanks for joining us.
Thank you, Brian.
And I'm the CEO and founder of FourStar Wealth Advisors, advisors to CEOs and insiders, chief dad to Evan and Quinn, and husband to the amazing Tripty. And I might say, everybody, we're getting a lot of watching of our show. We did a show from Antarctica recently and other things. So if you can, make sure that you do a 5 out of 5 ranking. We appreciate that. And then also send a copy to your friends so then they can start to listen and then maybe they can follow as well. But we're getting some great listenership and we appreciate that. A lot to discuss today, Chris. I mean, the markets are still pretty crazy post Liberation Day. And we just did an episode just after Liberation Day. So it's a couple weeks later. Chris, what do the markets look like today?
Yeah, markets. We've definitely seen a bit of a shakeup, I should say, with the markets. From the asset class rankings. So really the first time, probably since 2022, really we've seen a really big shakeup. We have a new number one, a new leader, and that is commodities. So it moved from the number two position to the number one position, and it's at 250 tally points now. And interestingly enough, even though it moved up a position, it actually lost 29 tally points from the last podcast. Obviously, the former number one position, domestic equities, lost more. Hence, it moved to the number two position, and it's at 234 tally points, and it lost 63 tally points from our last podcast, which, for frame of reference, this is April 22nd. We taped, I think the first podcast this month was really at the beginning, around April 3rd. So really kind of month to date. We've seen a big decline in domestic equities from an asset class perspective. International equities held steady in the third position. It's at 188 tally points, but it was -3 tally points from the last podcast. So, all those risk on asset classes, those top three commodities, domestic equities, international equities, all losing significant chunks of tally points really in
Yeah.
April. Now the ones that have gained the risk off asset classes, cash is in fourth still. It's at 164 tally points and it gained 34 points from the last podcast. Currencies jumped over fixed income to move into the fifth position. And it's at 135 tally points and gained 57 tally points in the month of April. So really that's the most that was gained so far. And fixed income moved down to the last or sixth position, and it's at 114 tally points, and it gained 29 tally points in the month of April. So a lot of changes there. We had two kind of asset class swaps, if you will, with commodities overtaking domestic equities and currencies overtaking fixed income. So I mean, I think that just really characterizes a lot of the volatility we've seen really since Liberation Day, as you said, Brian, and really the month of April has just been a lot of volatility, both to the upside and the downside.
Yeah. Yeah, it's really interesting, Chris. I mean, the numbers you just displayed are really the most extreme numbers we've seen in many, many years, where each group is moving tally scores of like 20 plus. And those are really extreme markets. Yeah, last week was a very extreme market. And so, and also to have commodities ranked as number one, we haven't seen that in numerous years.
Yeah.
Um,
Yeah, I think since 2022 was the last time beginning of 2022.
That's right. And so it's really not a great environment for investors. So we're heavy cash and we're very protective. We'll talk a little bit about that more later on just to confirm with everybody. But and then the domestic stocks and international stocks all went down. Commodities went down. So the three growth asset classes or the risky asset classes all went down big. And then the three scaredy cat asset classes, if you will, cash, currencies, and fixed income all went up big, right? As people flee to safety right now. And, we've been doing this for about 8 weeks now, Chris. It's getting pretty old, huh?
Yeah, I mean it's been these heavy swings in some ways. We've had these big swings up, followed by big swings back down. And a lot of this is news driven, and it's really hard for investors to manage that. I think that's why it's really important to have a long-term plan, because it's really easy for investors to get emotional and get kind of caught up in these swings, once again to the upside and the downside. And with the way the markets are right now, it is just too volatile to try to time which way things are going to swing next, and try to buy the bottom and sell the top. It is very difficult to do right now. The markets are extremely volatile.
Yes, exactly. So, well, good. So that's where we stand. And Chris, that's a real big statement right now. So far, the markets, the S&P's down starting the week 10.18%. That we were down big yesterday. We gained most of that back today. Russell 2000 was up. The only market that was strong last week was up 2.69, but it's down 15.6 for the year, and that's the worst. NASDAQ is also down 15.6 for the year, about equidistant, but that was also down last week. And then the Dow Jones, the dividend-oriented stocks, was down just 1%. That's only off 8% for the year. So the big winner, Chris, this year so far is dividend stocks relatively to the growth stocks. So we're in a value market, aren't we?
Yeah, I mean, we've definitely seen a shift to more of a value market, especially as we've seen the volatility. I mean, the spikes have been across the board, as you said, with some of these indexes, but the primary culprits have been tech stocks, these Mag sevens we've talked about. So we've seen kind of a flight from those, and more of a transition to quality value, kind of these consumer staples, these stocks that are more kind of the bread and butter, if you will.
Well, and speaking of quality and value, Chris, on the 11 S&P sectors, the healthcare market, it was strong, but right now utilities and consumer staples have eclipsed healthcare to be the number one and number two best sectors for the year. They're the only ones that are up for the year. Real estate sector, which was an offshoot of finance a number of years ago, is down just a 0.5%. So it's down, but not a lot. The big down ones, though, are technology and then consumer discretionary. Technology down 18.5% and consumer down 17.28. So those two sectors are getting really smoked, and the others are not as much. So what we're seeing essentially, though, is since there's such a wide divergence between the groups, if you're very nimble, this is a year that you could really outperform benchmarks, because if you just avoid those terrible sectors, you're not going to be down all that much at all.
Yep. Yeah, I mean it's a good year to just, if you are overweighting or looking at sectors, by just, as you said, steering away from, or even just lowering your exposure, instead of having a 10% allocation, even reducing that to 2% or 3% or cutting it in half, it'll help you a lot with
And
that so far.
anyone, yeah, and anyone who was around for the technology crash in the year 2000 to 2002, all you had to do in that market as well is to get out of technology and then telecom. That was the big sector back then, and consumer discretionary also. Those are the big areas of weakness, and everything else didn't do as bad, only about half as bad. So anyway, so these are interesting times. One good truth about markets, however, is that they do bottom eventually. Now, we talked a little bit about this in the past. Like, is it a possibility that the markets just keep going down for a long, or stay down for a long period of time and don't really rally? Well, hasn't happened that way in America. We've only had 2-year bear markets. But generally the markets will recover in the third year, even if we have a 2-year bear. We only had a couple of those 2-year bear markets. But have we ever seen in world history markets that have been down for a long, long time? Yes. And there has been when economies are basically broken. Japan had a very, very aggressive market high in the 1980s and topped out around 30,000 by their index calculation back in 1989, and only came back above that level last year. That's like quite a long time. And that's because they've got a demographic problem. They've got a lot of other financial problems caused by over leverage. We never got that crazy. I mean, we have ups and downs in America, but it never got that bad. And we don't think this time is going to be that bad either. We're seeing the economy slow down, and we're going to go into that. But the markets are reflecting that. But the rest of the world is in a lot world more of hurt, China and others, partly because of their own inefficiencies and partly driven by what we'll see from these tariffs. But the American economy is still relatively stronger. So we don't think this is going to be a terribly bad recession, but it could be. Nothing's ever for certain, but we don't think it's going to be terrible. But Chris, there's a little bit more about the markets you wanted to cover as well. I know that. So why don't we move into that?
Yeah, so I mean, one thing, just to kind of point out what you had alluded to, Brian. I mean, I think one thing we're approaching right now, which is going to play into a lot of this volatility, is Q2. We're in quarter two now. We're coming into earnings season, or we're actually in the middle of earnings season, beginning, and you're going to see a lot of the earnings come out, and they're going to, even if they have beat, they're going to lower projections. You're going to see this kind of um, kind of retrenching, if you will, with the CEOs as they kind of prepare to lower expectations, to fight some of this uncertainty, things like that. So, I would anticipate, seeing some of that volatility play out. But once we get those lower expectations kind of flow through the system, at some point, they're going to hopefully beat on those expectations would be the goal with what they set. And then hopefully at that point, bottoming and moving back up. So,
Yeah.
definitely it's going to be a process, but we should hopefully get through that from that front.
Yeah. Well, and then Chris, what's really kind of put everything obviously off the rails here a little bit with the markets is the tariffs. And President Trump is trying to remake the economy to make it more fair for America. And his theory is that he says it in a very crude way that we've been being ripped off. I mean, clearly we've lowered our tariffs to zero in most cases, and most countries have not done that. So he's trying to level the playing field and get either them to lower their tariffs or us to raise similar tariffs to them until they figure it out. The tariffs don't need to be there. They only need to be there when countries are trying to protect their industries and their jobs. And that's more political than it is because it's economic and then political. But nonetheless, President Trump, did announce Liberation Day. I think it was April 2nd. It was actually planned for much later in the year. And there's been some misinformation about that because people are saying that it was done very chaotically. Actually, they planned it for later in the year, but then when inflation started to ease, they decided to move up the time frame and do the Liberation Day then on April 2nd. But so now they went ahead and did that. But then, of course, everyone reacts right away, and some of the reactions were very sharp. So then they announced a 90-day hold. So now they're going to negotiate for 90 days. Now, we're not sure whether that was planned or not, whether they'd say, we'll come out with an extreme measure and then moderate it, or they had to jump. Certainly, the Treasury Secretary, Scott Bessent, is kind of really advising President Trump here. He seems to be the person who most has President Trump's ear. So it's possible that Scott Bessent told him, hey, let's pause this for 90 days. So it's unclear as to whether that was planned, but it is basically on hold for now, except for certain tariffs. And everyone has a 10% tariff across the board. So the American economy is bringing in a lot of new tariff money into the federal government, which is not a bad thing. Companies are doing business with us and bringing in capital to America. So that, I guess that's okay. But Chris, since that time, we've seen 7 trillion of deals forged of agreements between companies moving plants into America and cutting new deals that benefit America, which is great, and over 600,000 new jobs from all the companies that have been announced that are moving jobs into America as a result of this. So long term, it should be a net positive. Right now, of course, the opposition party is making lots of noise and they're protesting, and we see people spray painting the anti-Doge on anti-Elon Musk things all over Tesla locations and all kinds of different activities. But bottom line is, long term, it's going to be very good for America, most likely, depending on how it all plays out. So that's what we see. This is a very strange time because we've never gone through a big change in tariff regime like this. Certainly, They did some of that in the 1930s, but not in modern finance terms. So exactly how it plays out, we don't really know, but it should end up being a positive. But Chris, in the short run, what do we see in the economy?
Yeah, I mean, interesting metrics, kind of, I would say a mixed bag. Inflation, although inflation is showing really positive metrics, the US CPI for March came in at 2.4% year over year. That beat expectations of 2.6% and was down from 2.8% in February. So, good read there from the consumer price index. The core CPI came in at 2.8%, so a little bit higher, but that's kind of to be expected, and that was down from 3.1% and still beat the expectation, which was 3%. So both the CPI reads beat expectations and were down from the previous month, which is a good sign. And then the producers price index, which is kind of seen as a leading indicator in this front for March, came in at 2.7%. And that was below expectations of 3.3%. So really good news, at least so far in that inflation front. I know we really haven't seen the tariff kind of trickle through the economy yet. So once that does happen, we'll see. But so far, that looks solid. From a consumer sentiment front, March retail sales were 1.4%, which was slightly above expectations of 1.3%. So that's another positive. I mean, if we have people spending, inflation staying low, that's a good driver for the economy. And then in the jobs market, the U.S. non-farm payrolls for March came in at 228,000, which was well above the estimates, which was 135,000. And then separately, the U.S. private payrolls number came in at 209,000 for March, which was well above estimates of 127,000. So, great numbers there. That's good to see that, there are hiring, it seems like there are still some jobs out there where that's good. The March unemployment rate ticked up, though, slightly to 4.2% from 4.1%. I'm sure that's a combination of people raising their hand as more people come into the labor market, as well as some layoffs. And then the last thing I'll kind of mention from the U.S. economy, at least, is March housing starts came in at 11.4% in February. So, or minus 11.4%, sorry, from February to March. So that's the one. I think the trickiest part right now, the U.S. economy, or one of the trickiest parts, is the housing market. How do we get building homes that are affordable, that people can kind of move into and have people own or have ownership of housing and all that comes with that. So, we'll see. We'll see how that kind of pans out, I would say.
Mhm. Excellent. Okay. Well, it does seem like everything's slowing down. We are going to probably have a recession. This quarter is probably recessionary already, isn't it?
Yeah, I mean, I would say, I mean, it's probably, and we don't know for sure, but I think as far as estimates, it's going to be close, if not a recessionary quarter.
Yeah. Okay. Well, good. Well, what is working, Chris? Gold's hitting a new high, isn't it?
Yep. So switching to the commodities front, gold is, hitting major highs, I would say, a high of 3,500 per ounce, which is an all-time high. This continues as people are flowing into these safe haven assets. You have this currency volatility that's going on too. So, maybe previously people were flowing into the dollar, things like that. Treasuries were seen as safe haven. Well, now that you have some of this currency volatility even flowing out there, you're seeing just tweaks. And the other big reason for such a large move in gold is President Trump came out and ordered to open a probe into potential tariffs on critical mineral imports. So that was seen as a potential restriction of gold and maybe some of these critical minerals, depending on how they want to classify them. So
Mhm.
gold's still working, and that has been a major asset class and one of the big winners of the year. Oil prices too. I mean, a lot of volatility here, and year to date has not necessarily worked, but as of recent, we've seen oil prices rise, and a lot of this boils down to the U.S. Issuing new sanctions on the Iranian regime, especially on oil. So a lot of this is trying to pressure the Iranian regime to come into compliance with some of the nuclear deterrence, some of the nuclear agreements that were put in place, things like that. So a lot of volatility, especially in that commodities front, but there are trends that you can catch, and gold certainly has been, I would say, a long-term trend. And then kind of circling back To the international front, real quick, in the European and Middle East, so the ECB is expected to cut rates to 2.25% from 2.5%. So, they see the trade turmoil, everything going on, and they're anticipating that to weigh on growth. So they're anticipating to lower rates there as well. And then in a surprise move, and kind of obviously a smaller country, but in Turkey, their central bank hiked their key interest rate by 3.5% to 46%. This is actually a reversal of the previous easing cycle this was going through as far as cutting interest rates. So that was seen as a big move. Obviously, caused a lot of volatility
Yep.
within Turkey's economy there. And then the last little tidbit I'll mention, just kind of circling back to currencies, is the U.S. dollar is now at multi-year lows versus the euro and Swiss franc. Swiss franc is actually in a decade's peak as far as or near decade peak as far as touching that. So it's been almost 10 years now. It's kind of reached back to this level, and then the euro is closing in on a 3.5 year high versus the dollar. So we're continuing to see other currencies strengthen. The U.S. dollar weakened slightly there. So we'll see. I mean, I think this really does highlight why currencies was the biggest winner
Mhm.
of our asset classes, is this volatility, and we're talking about things that haven't happened in decades, kind of rippling through.
Yes. Well, and now you talk about gold and you talk about, the moves of gold and it's doing very well. Well, there's 7 states, Arkansas and 6 others that have already gone ahead and said we will now accept gold as currency. This week, Louisiana, Utah, and Texas also announced. So there's a total of 10 states now that you can actually pay for expenses and things in gold. So we had used to be years ago on the gold standard until 1969 under Bretton Woods, under President Nixon, when they decided to go to a fiat currency standard. And so then, of course, the dollar has devalued dramatically back then because there's no gold backing it. So there's talk about going back to a gold standard and lots of different opinions on this. But Chris, if we're just using gold to spend, and that's a gold standard right there, isn't it?
Yeah, I mean that's the ultimate gold standard. A lot of people, they think about gold from the international community as the actual currency, and you're just you own gold and you're exchanging it into dollars to maybe buy things easier. But they look at gold as that actual standard there, and how many dollars can you buy with gold type of a scenario. So
Yeah.
depends on your perspective, I guess.
It does. So a lot of people are concerned about our fiscal issues, and I know that President Trump and the current leaders in Congress are trying to get through tariffs and through other revenue producing items and expense cutting items through that Doge, trying to get they're expecting hopefully to get the entire deficit to go away, maybe even run a surplus, and that would fund some tax cuts, which is what they're hoping to do. They're talking about tax cuts for Social Security income, tax cuts for tips and other things. So we'll see if they're able to pull that off and not have a increase in deficit. My favorite proposal, which I've not heard much about lately, is that we have about over 100 trillion in assets in the federal government. We could sell 10 trillion in assets and pay 36 down to 26 trillion, and that would be a good thing, that we get rid of a lot of debt, the debt service, as well as just the debt overhang. We can't pass that kind of debt on to the next generation. Our generation has caused this. The leaders of the world now, and the young kids that are coming up don't deserve this. So we'll see. I think they're working on that. And as a result of the concerns, even though things are slowing down, pricing might be going up. And so there's still concerns over inflation. And that's why there's a little tug of war going on between the president and the Fed chief about lowering interest rates. They're not lowering rates yet. President Trump wants them to lower them to get the economy going. That'll help the tariff regime, but they're holding back. So there's a little bit of a tug of war going on. As a result, firms like Morgan Stanley Research and others are predicting only one rate cut this year. We came into the year thinking there were going to be as many as 5 to 7 rate cuts, and then they pulled it back to 4. Many of the economist groups are saying maybe only 2 rate cuts. Now they're saying only one. The key is, does inflation come back or not? We've seen some inflation in January. It slowed a little bit in February, but we'll see how things go.
Yeah, for sure. I mean, I think that's the biggest thing. As I said, it seems the inflation's still in line right now, but it'll be really. I think all eyes will be on the CPI, and PPI, and all these inflation indexes as we get the April and May numbers, because that'll be a big telltale sign.
Well, and this is the last full week of April, and the economic calendar is a little bit light this week, Chris. Right? We got a couple numbers coming out, but nothing substantial.
No, yeah, I mean just a couple of like durable goods orders, some jobs numbers, existing home sales, and then we get the final University of Michigan consumer sentiment number for April. So nothing major, no major releases this week, really.
Right. Well, so then we have a couple segments. I'm adding a new segment. What are we doing about all this? And most of the time when we report what we're doing, we're fully invested and we're getting involved in the markets where we can make gains and we take risk and make gains. That's not going on right now. We're in a very protective mode. So what are we doing about it? Listeners to the recent podcast issues might know that for the last 8 weeks, our FourStar protection plan has kicked in. And there are four maneuvers to go from maximum fully invested all the way to maximum cash levels. We have three portfolios that go to 50% cash and two that can go to as much as 100% cash or therefore protection. So through a series of signals over the last eight weeks, in the earlier part of that 8 week segment, we got signals to go to maximum cash levels. So 3 weeks ago, Friday, we finally got our final transactions in and sold back to maximum cash levels. So we have only done this, and Chris, you know this, of course, 8 times in 31 years of having a program like this. So it's not something we do every day. But many of our investors are very, very happy that we have not sustained the big downturns. And we're going to sit right here, Chris, aren't we? We're going to sit right here until things change.
Yeah, I mean until we see kind of a definitive move in one direction or a change from there. I mean, I think we'll maintain our current posture, and from there until we see things change and see some trends change, we'll stay defensive.
Yes. So we're at maximum protection levels. And, we got here through a series of indicators. It's not a light switch like you turn it on or turn it off. It's more like a dimmer switch where you kind of slowly get out and then you slowly get back in. What would get us back in would be continuing evidence that the markets are sustained in an uptrend rally. We don't buy economic numbers. We don't buy GDP numbers. We buy investments, and we need to know those investments are going to go up. So when we start to see the investment market starting to work, higher highs on the market and then higher lows when they establish a low. So higher highs and higher lows, our indicators start turning positive. Then we'll start to push more money back in and get back to fully invested over time. It could take weeks. It could take months. It's never taken more than a year. But we're going to be very protective here until we see those signs. We're having a rally today after a big collapse yesterday. So no real trend upward. We need to see more than one rally day to see any movement, Chris, don't you think?
Yeah, I mean, I mean, we've seen week-long rallies here as well. So it's delicate for us. We don't want to get what we would say whipsawed as far as in and out of the market. So we definitely have to be patient, not get caught up in some of this volatility as far as the upside, especially as well as the downside. So until we really see that evidence present itself and really secure more of a long-term trend that we've seen as far as an upturn, we're going to stay defensive.
Well, and many investors are very nervous, and we hear from some of our investors as well. But then when they realize they have protection on, they're not as nervous. Obviously, they haven't sustained as much decline. But if you're in a position where you've had a really bad situation with your financial advisor and they haven't protected you, we're happy to talk with you about it. Just call our headquarters, and we'll be happy to connect you with an advisor that can help you. But the key is if we can avoid major loss in a bad market like this, and that happens, only about maybe 10 to 15% of the time we have markets like this. The rest of the time, the markets are going up in a normal fashion. So if we can avoid the major loss, then we have that much less to make up, and we'll have a lot lower volatility in our portfolio as well at the same time. So that's our objective. And so far, we are maximum cash levels and maximum protection levels, and we'll stay there. We'll report in on future episodes and where we stand. But our FourStar investors are very well aware, I think, for the most part, of how this all operates. So,
Exactly.
so Chris, what else is out there? What's unique to talk about today? What do we see out there?
Well, the last week or 2 weeks ago, I should say, we had the Masters, and
Yes.
Rory McIlroy won the Masters, and they completed the Grand Slam. And it's been about, I think, about over 10 years since he won his last major, and the one that's always eluded him has been the Masters. So that was great to see. It was a great story. It was a great match overall. Went to a playoff, so huge event there. It was great to see, and congrats to Rory on the big win. Costco came out, so they released a new Kirkland signature beer, which
Nice.
had being said as a great value. It's a Hell style lager. So that's great to see. And then more recently, we saw China come back, and they directed their domestic airlines not to place new orders for Boeing. So we're seeing increased pressure on Boeing, from all fronts, really. Obviously, the domestic issues they've had, and now orders from abroad. So that'll be really interesting to see. Obviously, that's just kind of putting some pressure on, I would say air travel in general, as Boeing struggles to get jets out. So an interesting
All
thing
right.
to keep an eye on.
Okay, great. Well, and then yeah, we did talk a little bit, let's talk a little bit more about a little more serious stuff. We talked about how the tariff regime is causing countries to react, and most of them are negotiating with America, but China's not playing good ball, and they're trying to get other countries not to work with us now. We don't think that kind of pressure is going to work. They're trying to get countries to not order planes from Boeing, for example, or other goods. But the outpouring has been amazing. People want to embrace America and not attack America, even though they're not terribly happy with having to deal with the tariff issue. But they realize America is the largest market in the world, and they need to be here. So China, that's the tactic they're taking. That's what we're seeing out there, Chris, isn't it?
Yeah, I mean, obviously, it's definitely more of a attack, if you will, towards U.S. based airline company in this place, domestic
Mm.
airplane maker. But I mean, I think China's been the most reactive and combative with the U.S. on the tariffs that were rolled out.
Exactly. And then very sadly this weekend, just 24 hours after our Vice President J.D. Vance and his wife visited with the Pope in the Vatican, the Pope passes away. Very sad. Obviously, the Catholic Christian world out there is mourning the loss of their leader. And so this particular leader was very well known to the American leadership, and I believe President Trump and his wife are going out there, the first lady, for the funeral. This pope was a very different pope. He was the first American pope. I'm sorry, the first American but South American pope. But we have not had a North American pope, and so he was a very much of a break from the rest of the church. There were some policies were very much liberalized, so he did a lot of change in the church as well. But anyway, there's going to be a lot of people follow, the pope, obviously. He was a much more liberal, I guess, if you will, pope than others. But they will have another conclave, and anyone who is a Catholic who grew up with this stuff, where there was a white smoke and a black smoke, and we're going to see what college of conclave of cardinals will come in and vote for a new leader. But these, even though they're religious, they do have lots of effect on people around the world. They certainly have lots of effect on the economy, and also the world leaders of the world, do communicate with all the religious leaders as well, because it matters very much culture wise. Also leads leads to economics as well, and so that's why we're talking about it. So we'll see how that plays out, and probably by the next episode there will be a new pope in Rome. And I think, Chris, that's all we have today on our podcast. So thanks everybody for being with us. Please look at the leadership matrix, fourstarwealth.com. We have continuing blog posts coming on there. We have a blog post talking more about the gold rally and how to play the gold rally and how to be involved in it. And we're going to have some other podcast interviews coming up with some other finance experts and others, very interesting subjects. So we look forward to having you with us on those events. So, Chris, why don't we leave it there, huh?
Sounds good. Thanks everyone for listening.
Okay, well, for Chris Reardon, for the whole FourStar staff, our advisors all around the country, we want to thank everybody for being with us today. FourStar Wealth, until our next episode, over and out. Thanks, everybody. Bye-bye now.